Good evening, everyone. Oh, wow, there's quite a few of you. We'll start in about 1 minute. We're just waiting for the exact mark. I'll get cracking. Hope everybody's doing well today. All right, well, that's it for me, so let's get going. Like I said, hello, everybody. Welcome, good evening, good morning, wherever you may be. Today's webinar is going to be Fundamental Analysis, How to Trade the News. It's part of a series that we are doing with LegacyFX, starting with the technicals that we did in December, and then we did risk management at the end of December, just before Christmas, and now the second half of your analysis, which should be the fundamental basis. So to go through it, what we will be discussing at first is the risk disclaimer, obviously, about legal reasons. Take your moment to read all of this. And I think that will do just fine. Moving on. So what are we going to discuss? Well, firstly, I'll introduce myself really shortly, just so you have an idea of who I am and what I do. Then we'll discuss what actually the fundamentals are, how do they work, what are they based on, etc. Then we'll look at the preparation before the trading, before the announcements hit. And we're going to do that in several different ways, like developing your strategy, understanding how you're going to set things up, if you're going to preset things, or what you're going to do when you're manually, basically your game plan. As well as trading with fundamentals is then the next part. We're going to look at the short-term trades, which what a lot of you do, and we're going to look at long-term trading. And then the extra half an hour is obviously for the Q&A, because there's quite a few of you, so I'm glad we booked that in and not just the hour. We're going to need it probably. All right, so cracking on. About me, well, my name is Mike Rotting. You probably read the bio. I'm Dutch born, 35. I live in Greece right now. I studied international business studies through the Cambridge system. And during my schooling years is when I started trading for the first time, when I hit 19. Like most of you, screwed up the first few accounts that I made. Reading everything and following YouTube and this guru and that guru. And nothing seemed to work, because trading bots were also fun. That all never worked out. And eventually I started getting a few different ideas on how to do things. I started looking into technical analysis first, then actually trading strategies, and then later on in the stage, understanding the fundamentals, which we're going to discuss the basics of today. What does that mean? It means I have my own firm for investments. I'm currently also studying for my CISI 4, which is an international financial advisor kind of diploma. Furthermore, I've done a few of these webinars about my own trading account. I've never been a professional trader in the sense of a licensed trader for Goldman Sachs or something like that. I've always just been a retail trader for myself. I did some trading signals through Zulu Trade and eToro, things like that. I never really liked how that works, so it's just not my style. I rather just do my own thing. But that's why I started with the webinars. It's to hope to pass on a little bit of that knowledge that got me where I am today. So hopefully you can build to there as well, and then go from retail trading like me to multi-asset funds and bonds and structured notes and all that kind of fun stuff. Okay, so moving on. Well, firstly, what are the fundamentals? I often get then that they tell me, oh, well, that's the economic calendar. Well, that's where you can find the announcements, yes, but that's not technically what the fundamentals are. The fundamentals are the ground base of the financial market. So what does the market move on? How does the demand and supply get looked at from a higher investment point of view? We, retail traders, are a very small droplet of water in a very, very big pool. We do not make the market move. Over time, there's become so many of us that it's slowly starting to have an impact, and this is why volatility has gone out the window, because there's too many people trading that don't know what they're doing or where they should be trading or how they should be trading. This is why day trading has been dead for probably 10, 15 years by now, but at least in the old sense. So the economic fundamentals are the cornerstones. You have fundamental drivers, and then there's the normal announcements. But in general, it is the basis on which the currency is reflected, as in what is the strength of the underlying asset and where does it come from? It is an accumulation of different aspects. But obviously, we need to also know when these announcements get provided. Well, if you're with LegacyFX, they actually have the economic calendar available for you through their site. You can either log in on your account, or you can go to tools and you will see economic calendar. So let's open that. And you will find your economic calendar right here. Now, this, when I look at it, is set for, not sure what time zone this is in. Actually, it doesn't say, does it? No, it doesn't. Okay, well, that's not that important. But anyway, what is important is that once you know the economic calendar, you can also Google for economic calendar if you don't like this one. There's a plethora of different economic calendars that you can find that have different click-throughs, different filters. So kind of find one that works for you. It's not so important to specifically use one that that LegacyFX provides. You can use any single one that you want, right? Now, what is important is understanding impact levels. And in this case, the economic calendar has a star system where you have an empty star, half a star, or a full star. Now, what that means is that the expected volatility on the moment of the announcement, or the possible expected volatility. Some of the full star ones, like what used to be the NFP, and the non-farm payrolls used to be, is probably the most known ones, right? Trading the NFP. And we'll get back to that later as well. That used to be the most important announcements basically of the week, of the month. What happened was that would determine for the next week and a half what the US dollar would do. That day is long gone. But it still retains that 3-star rating. Even though at the time of the release, it doesn't really affect the trend anymore that much unless it's extremely out of order from what is expected. Now, sorry, let's see here. Sorry, just something popped up in my screen. I'm trying to get rid of that. How do I get rid of this? Go back. Thank you. All right. Crude oil inventories. So that's the first announcement. We're going to look at that in a minute. What they individually mean is something that we can't get into right now. There are a few sites that have like a click-through system where you can learn what they are and see the history of them. To understand what happens when a certain announcement hits, you should learn them first. Don't trade them. Look at what they do. They get an announcement. You make a prediction. Make a few lines on your chart, right? Pretend you're opening a trade without opening a trade. Learn how things flow. And then slowly, once you fully understand, hey, crude oil inventories, when it's positive or negative, means XYZ. And on these currencies, I can expect that many pip movement. On this currency, I can expect that many pip movement. You can see this because when you look back in the economics calendar, in the history, this is how I learned it, is I just went through the last 5 years of trades and look at every month's announcement and see how it differed from the month before. However, you need to keep in mind that this is not the only factor, right? Whether it be crude oil inventories or the production industrial index or the NFP or what's obviously a very hot topic is the interest rates. Like March last year with the AUD, that was fun. But you need to understand that it differs on where the market is by price as well. And your technicals will help you with that. We're going to go to some charts in a bit where you will see, I will try to show you a little bit what I mean by that, as well as how to open trades and how to set them up. But what the important part is that first find this and then read through it. Learn every single one. Start with the ones that are, let's say, 3 stars or exclamation marks or 3 skulls or whatever their indication is for high volatility, probable high volatility. Keep in mind that high probability of volatility is usually on short-term trading. In the long term, in general, there are more drivers, fundamental drivers, that actually determine where the market goes. Because these drivers, sorry, I need water. These drivers is what the bigger parties like multi-asset funds and the big heavy duty investors that do direct market investment, that's what they base it on, right? They don't look at, okay, what can I trade today and let it run for a week? They look at what can I invest now and take out in 6 years, right? It's a completely different way of looking at things. So don't think, because there's a few things like bond yields. If you watch Bloomberg, they always talk about bond yields, and you never see the market move when these bond yields get announced. It's because in the short term, they're not that important. I have a few investments in bonds because they're stable. They're not going to go anywhere, but they don't really make that much yield at the moment because they're based on interest rates. But it's like, they're the underlying core of how's an economy doing. So for the long-term investment, you want to know this one. So this is not only understanding the impact levels, it's also understanding the data, right? So like I said, you pick one, like let's say the NFP. Find the NFP, and then you simply go through it one by one until you get to the end, right? And you go back to your chart, right? So you cross-reference what happened with a certain NFP to in your chart that you want. I see a few people raising a hand, by the way. We have so many people, I can't answer the questions. There will be an extensive Q&A at the end, and then we'll answer all the questions if I haven't answered them yet, to the best of my abilities. All right, so moving on. So now that you have the economic calendar, you've studied up on, what are the instruments we're looking at? What is the data? How does it affect the market in the last 5 years or the last 5 months or whatever, how intensive you want to read into it. But, you're not a fundamental trader. You say to yourself, like, I just want to occasionally make a little trade on the news or know how to deal with it when it happens. Okay. So that's part of how to determine your strategy and what to do with fundamentals, right? When you talk to these trading guru guys that say, well, fundamentals is only 20% and the other 80% is technical, it's obviously nonsense. The technicals get made because of underlying fundamentals. It's a ask and demand kind of market, right? There's people investing in the actual underlying assets. We're trading the price difference, right? We're not investing in the actual currency. So where that happens, it is important. And that's where everything is based on. And this is what makes the market, right? For instance, why is the Aussie dollar so strong, even though that they cut the interest rate so hard in March last year? I'll use that as an example, by the way, later on in the chart. Like, it spiked completely out of control. Like, it completely decimated the currency value for like a few days. But a week later, it was back to the same strength and the economy actually got stronger. So this is how investors drink, right? It's just this instant, like, oh my God, we didn't expect this, pull out my money. And actually it's fine, pull it back in, right? So our little droplets of trading is not going to affect that as much, right? From the 4 trillion in the market, I think the retail traders make up like 1.5 at best. I think it's 6 trillion by now, actually. Anyway, so there's a few things about your strategy apart from understanding from, okay, what is going to happen when the announcement hits? It's also, okay, what kind of trading do I want to do? We're going to look at that at short and long-term trading, but you need to understand upfront, what do I want to do and what is my risk level that I am going to take? And you have to stick to it. The biggest mistake any retail trader makes is not believing in the strategy that they back tested, that they've made, and then when happens comes, they see things moving and they start to panic or they start getting emotional with it, and then they start improvising on the spot. No. Right? People that trade emotionally is because they don't have a strategy. If you have a strategy, it's back tested, it should work. You just have to trust the numbers. There's no trading account that has 100% win. Right? So before you do the announcement, analyze the instrument you'll be trading. For instance, do your technicals, set up your indicators, understand the price levels. A good example. And like I said, we'll go to the charts when we start talking about the actual trades. Let's say the euro US dollar would be at 130. It's at a monthly resistance after a long, spurt, because the US dollar, we have our new president, the new US president is there. We kicked the clown out, we took another geriatric dinosaur. So we put that down there and everything goes sideways like it is now. Well, the euro just had a massive rally because of that versus the dollar. Okay, great. Is that going to stick? No, obviously not. Because in the end of the day, whoever's in office, how idiotic he is, right? Things eventually fall back down and they balance each other out. They do not make. Politics has an influence on the market. Of course it does. Geopolitical, even more so. But in the end of the day, the investors are the ones that make it happen. The ones putting the money in. Politicians don't do that. Asset managers do. Okay, so make sure to understand that, okay, if my price level is here, like let's say 130, and I have a high resistance and the NFP comes out, that is around expectation. Okay, don't expect it to change much of a difference. It'll probably just keep banging on that resistance and keep moving sideways. But now there needs to be a correction. At some point, these guys want to cash in. So the money gets pulled out and it will drop and retrace. And there's usually a level of retracement until investors start investing again. This generally has like this tendency to overrule with something like Fibonacci or something. There's a mathematical background on that, but it has to do with just demand and pricing, right? How much profit did you make, then reinvest at a certain level, and we keep going. Okay, so when to act? All right, this depends on your strategy. Never, if you are a beginner, is the only thing I can say, never, ever, ever trade the moment the numbers get presented. First of all, because you are a beginner, even if you understand what the fundamental is, you don't know how the market reacts to it good enough. And you just don't have the experience to react to things fast enough, like, hey, is it pulling back, or is it just a sporadic pullback, or is it a corrective pullback? What's happening? Have you been trading the same currency for the last 5 years? No, you've been doing it for 3 months. Okay, you don't trade at the moment of the announcement. Wait out the first 5 minutes, especially at a volatile one. And the reason I say the first 5 minutes is because that's the initial like quick clickers that are starting to make their trades, and you see this candlestick is usually jumping up and down like crazy. Like it goes green, red, green, red, green, red, or it like spikes really high and then it pulls back all the way and then it spikes up again and then it pulls down all the way into the red and then back up to green. It's like it's just mainly the scalpers just doing 700 trades in 1 second, just in, out, in, out, in, out. Like you can't react to that, so don't. If you have the strategy of, hey, I'm going to do pending orders, something that we're going to look into the chart in a minute, you've already done your acting. You're already done, right? At this point, you should just look at it, and preferably, to save yourself heart stress, not look at it. But you have to stick to what you think you are going to do. The other option is obviously manually opening about 5 minutes after the first like weird spike happens. and then understanding, okay, so I understand this instrument is at X, Y, and Z. This is the week, day, and 4-hour chart. We're at this and this resistance, we're in this trend, it's going in direction of the trend or against the trend. Therefore, I take a short or a long. And then you determine your lot size based on, you know, which direction you plan on going. And obviously how big your stop loss is going to be, which you should have figured out before you started. Which is setting goals and risk levels. Right? In my technical analysis webinar, I explained to when you do entry points, you should know already where your stop loss is going to be. The stop loss is generally a fixed point in the market pricing where it should not go unless something goes sideways. So the better your entry point, the closest to this point, the smaller your stop loss, which means that higher your lot size is going to be. Because if you do it right, you're risking a fixed percentage of your account per trade. In an overall, you'll have a link. Now, when you're trading fundamentals, however, you should be doing slightly less than your fixed amount for your normal trades. Right? So let's say you determine you're comfortable with 5% of your capital per trade, then do 2% per capital of your trade during the fundamentals. Keep in mind that you're setting this goal for yourself to trade on that volatility at the moment, not to try and expand your portfolio of currently open trades if you do have them, which you should have. Now I put spreads and commissions in there, depending on the broker that you're with, right? So like LegacyFX, obviously everybody has spreads, they have commissions, and you have different accounts that have different spreads. So you need to know that for your own account, I can't tell you. But what is important to understand is that generally during the announcements of high possible volatility, your spread and commission might increase. Spreads usually are increased by default because the market influx creates that increased spread. Right? It's the difference between bid and ask. Your commissions is usually fixed if there is a commissions with your broker. Right? It could be 0 and you just pay spread, or usually it's a bit of a combination of both. But keep that in mind, because if you think about trading very small amounts, like I go in and out for 10 pips, and your spread has increased from, let's say, 1.5 pips to 5 pips because of a big spike, you didn't make 10 pips of profit. You made 5, which is nothing. Honest, under 500, you shouldn't be interested, but it's me. All right, so let's now start moving to the actual fun stuff, shall we? Why is this not going further? No. Whoops. Not sure what happened there. Sorry about that. Where were we? I got stuck for some reason. All right, so first let's start looking at some short-term trading using your fundamentals. And this is where we start looking at charts. Now, let me just switch to this one first. This is the Euro US dollar, and this is on a daily basis. And this is a completely, blank chart basically. Before you ask the question, no, this is not how I trade. There's way more on there. But obviously if we put everything on there, you don't know what to look for. So I bet some very basic technicals. I zoomed in quite a lot. I never look at it. I would look more at it like this, because I don't need to see all the flim flam, but for purposes of you being able to see what we're looking at, we do this. All right, so trading the fundamentals. Okay, so short term first. There's 2 ways of trading. Right? You have your trade that is called timing in the market, which is when you trade on the news at the moment of the news is what you're doing, right? You're trying to time your trade. And there's time in the market, which is a long-term trade. Now, these are the overall more consistently profitable trades, and that is what you should be doing in your strategy. but it doesn't mean you shouldn't be looking for opportunities to grab as much as you can along the way, right? Apart from the fact that most people can't sit still and just not do something for, you know, a quarter of a year, looking at the same trade develop. You know, we'll keep that on the side. Now I just got, can you? Yeah, we should be fine. Okay. Somebody said they couldn't see, but it should be fine. Right. So short-term trading. Obviously, you're not going to do that in a day chart, right? This is the overview you want to have for your long-term existing trades, you know, a week. Now, would you do short-term trading on 4 hours? Probably not. Like, this is maybe entry point for your longer-term ones, but in my experience, these 4 here, anything that says M is M for moron. People don't trade on that. A real trader doesn't use 5 minutes or a minute or 15. It's like, what are you trying to trade? Like in the old days, you could have done that. By the old days, I meant when there was actual volatility, when you could make 600-700 pips on your US dollar in a day. You can't. I mean, the candlesticks for a day now are less than that. I mean, let's see, this was an okay day. I was like, look at that, it's 550 pips. It's like, I used to do that in an hour. So this is an entire day, and that's if you nailed it at the start, right? So there's not enough volatility for that. So forget about this. And I'm going to talk about scalping in a minute because there's big misunderstanding of what scalping actually is. So I blackened it out because I was trying to get empty, like the old days in MT4, where you could pull this forward so it just gets hidden, which is kind of sad because that's what I wanted to do. So we're going to do it like this. So this red line symbolizes that that was a candle in which an announcement was made. Actually, at the very end of it, so I should technically say it started here, but anyway, doesn't really matter. So can I insert an arrow? Arrow. Does anybody have any idea which announcement could have been on the 8th of January on euros US dollar? Why does this not get bigger? Whatever. This candle. I'll just highlight it differently. The chat should be on in case for those that all right. So this one. Oh, it doesn't do that half anymore. All right, doesn't matter. So this green one is where we're at. There we go. So the announcement was there. Let's see who's got it. Election, NFP. Yes, one person got it right. Yeah. Yeah, it was the NFP. That's right. Now, was the NFP positive or negative? Who knows? Exactly. It was negative. Very, very negative. Instead of an expected very low amount of increased jobs, they actually had exactly 170,000 jobs down the drain. So yet unemployment didn't actually decrease that much. That's because the US is quite big. So how come that, you know, when something like that happens, normally you would say, okay, that's very bad, so the euro should have like skyrocketed there. Anybody have any idea why it didn't do that? And this comes part of analyzing your instrument. Okay, so we're going to get to that in a second, Marcus. So if you dictate it, if you go to a smaller time frame, which you don't trade, this is the actual announcement. Now you can see that it corresponds with the 1 hour candle that we had right here, the green one. Jesus, stop. It's a bit sensitive, sorry. Basically what happened, it just jumped up and down and then stopped in the middle, which is weird when you think about it, when instead of an expectation of already a bad drop to only 70,000 expected new jobs created, it actually went down to minus 172, I think it was, 1,000 jobs. So why didn't it move that much? Well, it's very simple. If you would have done the technical analysis properly, you would have known that it was already at a resistance, and you would have known that it's already at a price level where, what's it going to do? It was dead smack on the previous resistance that it tried to leap through, but didn't quite actually do that. Because this one, we look at it. We got this webinar thing anyway. This is the actual channel it's in. It's at the bottom of the channel. It wants to complete its flat line. And the price point that it's at is way too high. This is a weak chart. Look at what price point we're at. Like the high, it's only been higher in 2017. And then you have to go really back in history. Like the euro is already so inflated in price because of all the shenanigans that happened, throughout 2020 with COVID, and the US economy being hammered so hard. Yeah, exactly. So not only that people are jobless, we expected it. Investors knew it was going to happen anyway. It's nothing shocking that, yes, there's 200,000 people more unemployed. Yeah, okay. That we knew that. Half of Europe ran out of jobs. Right, we're working from home now. All right, yes, we were working from home, but for instance, I was dealing with Poland at the time, at the start of everything, with something else. And the day that the COVID lockdowns were called, the company that I was working with from Poland called me and said, look, I won't be able to make payments this month. Like, oh, okay. Due to COVID, I understand. Okay, you don't have the investment funds. No, in my company, I have to fire 50% of my staff because they're going to prevent me from doing it next week. I was like, sorry? 60% of Poland just got fired in day one. Like, companies don't have any more breath after 2008. Now, the economy recovered from an investment point of view, right? From a driver point of view. But for the common people, everybody knows there's still plenty of problems that came from the crisis. We're nowhere near finished yet, right? People are still having trouble getting jobs. Paychecks are still way too low compared to the market value because we're still using the same excuse, right? So keep that in mind. Use your common sense. Technicals and fundamentals together is not even everything. Understand how the investor on the actual asset would think, which is banks and larger corporations, like asset managers, like let's say Goldman Sachs with 150 million to invest in one single asset. I got something tied up in a fund that has a mix of cash, equity, CFDs, commodities, some stock, and equity. That's one of my bundles, right? So you spread it out. You don't keep it in one thing, right? So the amount of cash input, nothing is growing because nothing is moving. It can't during COVID. In order for money to work, it needs to be spent. Generating income is great, but the problem is it needs to go out on the other side. Right? There's a book, I forgot who wrote it. It's the meaning of money, I think it's called. I need to Google that. Basically, it explains very well how, what the actual value of money is, what it really is, and how it works and how it works and how it works in the market. This is what you need to understand in conjunction with your investment, in conjunction with your fundamental analysis. So, right, so here in this particular scenario, right, even though we were, closing on a resistance, you know, you had a starting downtrend, I would have never taken a buy moment there, because you already have the momentum against you and you would be trading against the trend. We know from the past the NFP doesn't have the impact anymore that it used to, right? It doesn't have the trend defining influence anymore that it used to. And this was an extremely bad example of the meaning of money. Thank you. That was it. Yeah. I should have it on the shelf somewhere here. Anyway, off topic. So it's important to understand, what is my market situation? Where am I going? Your short-term trades, I advise you, like I said, don't trade anything with an M in front of it. If you're going to do short-term trades, you do 1 hour. You could have traded this. Now, depending on what the market was at the moment, I would have tried to look, if I would do it manually, based on the things that I just told you, where the market is, the resistance, etc. You know it was going to recover into a sell, right? Into a short, regardless of what the number was going to be. So the only thing that a negative NFP would have done to boost the euro momentarily is give you a better short entry position. Now, how do you find that? Well, in this case, you would have had a good opportunity to look in it 2 ways. You would have just plopped this resistance in right here, which is the bottom of the previous high that it had to break through, right? So it's roughly here you have the most connection points. It's roughly around this area. I would have either set up a manual trade as a sell the second I saw it spike past that point. That's option number 1, that's manual. But if you do manual, you need to understand, the second you open it, you don't need to set your stop loss right away. I see a lot of people struggle with that. Like, they open a trade and instantly start moving their stop loss. Your trade is open. You didn't open it to close it in the next 5 seconds. You opened it to let it develop. So give it a moment. Okay? So you opened your trade, right? So let's say you opened your trade and you were a bit eager, you were a bit early. Let's say you opened it right there. Can I get this? Thank you. I want this to be a dotted line. Something like that. Green. So this is, oh, that's too thin. Okay, so for visual reasons, I'll do it this way. Okay, so let's say you took the short there. Let's say, yeah, we'll start with the short and we'll do the long after that. So you took a short. What would be your stop loss? I'm going to give you 3 options. Let's say, so this was the resistance point, so you put it there. That's option number 1. And then I actually need to go here, because you should have done this before the announcement, by the way. Option number 3. Now, we have option number 1, 2, and 3. Which would be the more correct stop loss? 1, 2, or 3? Who thinks they know? That's how I would do it, by the way. Okay. All right. All right. I'm glad nobody's picking 1. Don't pick no 1 because you see a little line there. That's cheating. No, most of you are right. It's number 2. Number 3 would be safe as well. But remember what I said. Your stop loss and your entry point, the distance between those two determine your lot size. So the bigger your stop loss is, the smaller the lot size, thus also the smaller your potential yield profit. So yeah, most of you got that right. So we'll take those 2 out, boom. So you have your stop loss, you set that up, like you open the trade, you grab this thing and you go like, okay, put it here just above that resistance. That's like a no, 1 hour resistance probably around there, somewhere between the two 4 hours, because the other 4 hours are here. So just above it, just in case it does like a weird nip spike, it might go here, but don't panic. It's called a down draw. I don't care what it does. I know it will eventually correct itself to the median of this whole story. Now the question is, where would my profit point be? We have, for instance, we could do here. Now you could say, okay, it's going to go back to the candle. We have option number 2 is like, okay, back of the previous spike. That's usually the reset. And, it is a, Friday, so I don't want to keep it open for the weekend. Or is it option number 3, the next big resistance? I like how one person thinks it's Harry's. Very good. That's not entirely right. Yeah, there we go. Serena got it right. So you have 2 options here, not all 3. The reason you don't have all 3 is because of the basic risk reward ratio. This is almost one-on-one. Actually, this is less than one-on-one. Right here, you're trading with a stop loss that is 380 points versus a take profit point of 320 points. Why would I risk more money than I'm willing to make? That makes no sense. Okay, yeah, there's also that point. That's exactly right, Frizz. So if you take option 2, it's okay, but if you are opening on the day of the announcement, but keep in mind your risk reward ratio is still not good, right? Because you essentially want at least 2 to 1. And this is 560 versus, let's say, 380 was. So it's like times 1.5. It's not exactly there, but it's at, based on these resistances. I'm not looking at any of this. I'm looking at this last spike. That was the opening. So you would be somewhere in this area in this cube with a trailing stop loss, probably of like 20 pips or something. And you would have nipped it. You could have made more profit on the spike at the last part of Friday, but you would have been content with that because it did pull back in. And if you would have kept it open, yes, you would have made more profit if you had option 3. But for option 3, you should have been in the market earlier. It's okay to go for option 3 though, as long as you control your risk along the trade line. For instance, on Friday, just before closure, you should have logged in when the market was somewhere over here, right? So this is now your your effective trade. Let's say that's the market price. You would have either manually moved your stop loss, which was from your entry point here, we said, to at least secure half of your profit in case there is a weird opening, or it should have been a trailing stop. And you do the trailing stop based on probably the average movement up. So if we look at the candles here, the up candles, the full spikes, this was the announcement one, so don't count that. These 2, these 3, okay, that was while in an uptrend. So in an uptrend, you look at the red ones. In a downtrend, you look at the green ones. You're trying to not get caught by the retrace, right? So that's 15, and this one is from there, so it's 6 extra, yeah, 30. So like 20, 25. That should be a trailing stop. And then you would have indeed hit it on Monday evening. Right, and then you would have made a proper trade of about 120 pips. Still nothing amazing to write home about, but it's better than most people do. Now, one of you asked the question, how do you know if you should do a short there? What did I mention? Who remembers? How did I know that I would have never taken a long there, regardless of the news? There we go. Because yeah, the trend was short. Yeah. So not only was the trend short, we were expecting a bad NFP anyway. So it doesn't matter if it's somewhat bad or really bad. The investors had already thought about it. Doesn't matter what the NFP does. It's not important right now. People are going to be unemployed. There's many more to come. It's going to get a lot worse before it gets any better. Investors are saving their money. They're shifting their investments to other things, like, for instance, I don't know, Zoom stock, for instance, right? A little bit of Amazon. More into, tech companies are very big right now. Structured notes are very full of tech notes. Silicon Valley is receiving huge investments because everything is shifting to digital. Now the world is forced to go digital. So that's where you see the surge. So that's where the money is going. Equity still a little bit because the housing market kind of like fell a little bit. So it might be a little cheaper to buy, but most are waiting for it to drop a little bit more. The euro could never get higher because we already knew, based on our weekly analysis, that we were at a very high price point compared, like 2017-18 is the last time it was at this kind of price. Will it go further up? Yeah, probably in time, depending on what the new guy in the US does. At this moment, nobody's really impressed with what he's done so far, but he's only just been there, so let's see what he does. But right, the US economy is a bit of an interesting beast. Now, another part of short-term trading is people that do trade in this M thing, and they say, I'm a scalper. No, okay, it's great. You're an idiot because I don't think you know what scalping is. First of all, what you need to understand is that when they talk in the bigger trading things about scalping, in retail trading, first of all, the broker needs to be able to allow it. Second of all, you need an extremely, extremely good deal when it comes to spreads and commissions, as in it needs to be less than 0.5 pip value combined. The whole essence of scalping is going in and out in microseconds, grabbing 2-3 pips and going out. The supercomputers that do that are situated next to the stock market, that what the stock market, like for instance in Wall Street, is complaining about, is that these supercomputers have algorithms built in that do 700 trades in the split of a second, all at once. That's scalping. Because 2 or 3 pips at a time with no stop loss is a massive risk when you do screw it up. If you do 700-800 of them and you win 780 of them, you still have 100 of them being the profit part. And that was 1 second. Now you do that for 24 hours, 7 days a week. Apart from when the market's closed, obviously. Right, so Monday to Friday, during the bell opens to the bell closes. You can't react that fast. Neither do you want to be able to react that fast. You should be using your brain to think and plan ahead on what to trade. Like right now, scalpers are going, sell. It's like, what do you mean sell? Oh, wait, what happened to my chart? Hello? Oh, that's interesting. Bloop, there we are. It's like, you see a lot of volatility, I know. I just see in consolidation, it just had a bounce and pullback. Nothing new. Right, remember where we had the resistance line here? It's probably going to bounce into that a few more times, maybe break through it. If it does that, it's going to go to the bottom of the trend channel. And that's it. So you want to look for sell moments now. So you want to find when it's high and try to take a sell, right? In the overall scheme of things, we're still in an uptrend. Unless it breaks out of this, which I doubt it will at the moment. But there's not much movement here. Like you basically, you're talking about going down like another 40 pips or going up another 100 pips. Like I wouldn't trade this right now. There's not enough movement in it. All right. So, but scalping, like I said, people talk about scalping. It's like, yeah, I went in and I grabbed 5 pips. Okay, great. How much did you risk? I went in with like a mini lot. Okay. What was your stop loss? I didn't have one. No, because that doesn't work with scalping. Yeah, but I won 10 trades. Okay, good. Yeah, but yesterday I lost one. Oh, okay. Then the one wiped out all the profit of the other 10. Yeah, by double. Yeah. Like it doesn't work. You need volume and you need volatility for that. And there's no way you can click that fast. So forget about it. It's a thing of the very old days when it was possible to occasionally scalp on even an hour candle, an announcement, and you would grab 200-300 pips in like 30 minutes. You basically have to go to exotic pairs to get that kind of pips, but obviously your commissions work different, your values work differently there. So it's not that much of a yield. And in the long term, you should be looking at an account that gives you profit over time and grows you. It is not a get rich quick scheme. Not saying it can't be done. I had a client that got lucky as shit. I made him put in 10,000. He walked away with $500,000 a year and a half later. Okay, he got literally lucky with every single thing I gave him. All right. Never happened again though. And he also doubled down, and even though my warnings, he just kept going. And it worked out for him because I literally cut him off. He did open another account somewhere else and lost $500,000 of it in like a week. Right? So greed is another thing. So the manual part, like I said, is opening it at the moment about 5 minutes later and knowing where the market is. That's what basically we just did. For a beginner, you should actually think about pending orders. The way you need to see that is by you calculate way in advance of the announcement, hey, the market price is here. That means that my profit and stop loss should be X and Y, which means that the distance from my entry point to my profit point should be to my stop loss is this, which means that that should be the lot size. Okay, cool. And then, okay, I let it run. I set up a trailing stop once it hits this many pips for that many pips, because then I'm okay with it. Even if it runs to zero, not losing is still winning, because the point of the whole thing is to grow the account over time. Okay, I've set up my pending order and the announcement is at 8. I'll make sure that I'll be golfing at 8. Whatever I do, I don't want to see the chart. That's how I usually tell my people to start when they trade fundamentals. And the simple reason is for that, when they see a chart move, they see their equity move. And when they start seeing numbers move, they get anxious. It's like, take the money. No. It's like, how many times, think about yourself at your start, because I did the same thing, don't get me wrong. That's how many times have you done that? You had a trade, you thought it's going to go wrong, so you take a small loss or a small profit, and then 2 days later you would have had like the biggest freaking winning trade ever. We've all had that one. We have also had it the other way, so it worked out in our favor. Right? But if you work with a trading strategy and you set it up correctly, most profitable trading strategies lead less than 40% win rate, simply because of risk reward ratios and risk management. Now, by doing it right, you generally end up with 60 to 70 to 80%. 80% win rate, you're pretty damn good. I was hovering like 73, I think, most of my career. But my strategy that needed 40%. So if you make profit with 40 at 2 to 1, not 2 to 1 risk reward, I was usually doing 3 to 1 risk reward, and sometimes 15 to 1. You need to think long term. The longest trade I had running was a year and a half. It just kept going up and up, pound. But yeah, and then you have things like layering. You do extra trades on top of it. You do natural hedging within your portfolio. You develop your portfolio with more trades, and you use the fundamentals for this. Huh? You plan ahead for the long term. So let's take a look at the long-term trades. Well, how do we do this? So let's say you have open trades. Now, there's not much you have to do. If your trade is profitable or at entry point, there's two things you can do. If it is at entry point and basically no loss if you would claim it, or no loss at all, better. And it's a fairly young trade. First of all, you didn't plan ahead properly because you forgot there was going to be an announcement. But okay, it happens. You're all human. So you set this up. All right, so you have your trade running. You're, let's say, 30 pips in profit, pretty decent. There's going to be an announcement in a minute. What are your options? There's two. The one is obviously you close it. You take your profit, don't take the risk, wait for the announcement, and let it go. There's two other ones. Anybody want to make a guess? Don't I like it when it's interactive? Yeah, I gotta learn if I just tell you everything. Not bad, James. Yeah, that's what I usually did. Either I would set my stop loss to just above the entry point with a small prop. Exactly. So basically a stop loss that you have all your expenses covered, and at least you don't make a loss. That's the most important thing, right? No loss is winning in trading, right? When you have a structured note, for instance, they can run up to 6 years. Most of mine are 4, but when you have it 6 years, worst case scenario, if you do it properly, you wait 6 years for getting your money back, which is, shit, but, at least you didn't lose anything. The other one is exactly what I mentioned before. You set up a trailing stop. Now you can do either this manually too, James. Yes, you're right. You can do this manually. So basically you sit in front of the chart and you move the stop loss with it. Generally though, I would recommend just setting up a certain amount of pips. You can generally backtrack your chart a little bit to see when the last time this announcement hit, and to see roughly if you can filter it out. If you just put on the month, just put the lines on the days, and see how that announcement handles usually. You'll get an average number out of that, and just make it a little bit more than that. Right, that way it shouldn't hit it, but if it does hit it, okay, c'est la vie. But you should never have a situation where you have a profitable trade and you end up closing it in the red. That's just bad management. If you have that often, your issue is not your trades, it's your risk management. Because honestly, think about it. Like I said, strategy of 40% win rate, that's worse than a coin flip. You could literally flip a coin every hour and do better than that. But you don't stick to it. You kind of open it and then 10 minutes later you change your mind, or something happens and it's like this is things that happen when you don't actually have a strategy developed and you just kind of like randomly do what you want. And this is why it's important to take a step back, take a breath, and develop your strategy and take it from there. So when we do a new trade with the intent of a long-term trade, it is only possible if the market is at a price point where it is a turning point. For instance, let's say that this channel wasn't like this, but it was like, I don't know, something like this, right? And it would be at this corner here, and this is where the announcement is. You were going to take a short anyway. Yes, it's against the trend, but it's in the top of the channel, and you can write it back to the bottom of it. If we look at the median and the average angles, etc., blah, 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 then you would be looking at, let's, for argument's sake, do something like this. Is that the average movement? Yeah, it is. So something like this, so you would hit it somewhere over here. Why does it keep? Stop it. Oh, it's this, you can't see that. I can see it. So this, then there's a resistance here. Okay, so you would basically plan this in. So that would be your short anyway. That's your short for the next 4 or 5 weeks. Maybe 2 months. It will probably go here, this line eventually. Even if it's just a reset, doesn't matter. The other option you have is waiting for it to do that and then take the more solid trade, which is the buy when you're in an uptrend. Right, so if you have an announcement and you're in the bottom of the channel, in this scenario, and you're in an uptrend, so let's say the announcement was just after a very bad day, where it did another one of those, and you were going to take a buy anyway, and you buy big. Because regardless of what the announcement's going to do, it will most likely go up. Because you know it wants to complete the run now to the new price point up here. Right? Market drivers, market fundamentals, big investors, they want to get the price back up there. Market makers is one of those fun words. Right? So there's going to be push for that. So as a retail trader, you just want to ride the train as best you can. No, how does this? Sorry, sometimes there's little things there. There's really a lot of you. Okay, so when you think about long term, you just heard me say 2 weeks, 3 weeks, a month, 2 months. It's perfectly okay as a retail trader to set up trades that will last you a quarter of a year or even longer. Like I said, the longest one I had was about a year and a half. Just kept going the right way, so just kept adding new trades to it. But which is kind of like compounding your trading. It's a different thing, but you move your stop losses with your trades basically, and then you just keep adding on top of it. So in this case, you have one trade, you picked it at the right time. There's no reason to close it if you have the absolute feeling like, okay, it's at the bottom of the market price, it needs to do something. For instance, let's say the Euro AUD, if you were there last year in March, who remembers what happened last year in March with the AUD? Anybody know? They costed me a lot of money here, the bastards, but I made a lot of money the other way around, so it doesn't matter. It blew up. Well, yeah, it did blow up. It did blow up, yeah. But why did it blow up was the question. We're doing fundamentals, so it is something fundamental. It was pretty big. No, it wasn't lockdown. Who's Googling it right now? It was the interest rate decision. So instead of staying at a 0.75, they decided to kick it down to 0.5. Yeah, they pushed it down. And that was kind of surprising considering the position that they're in. But the economy was inflating kind of out of control, so they had to. If there's any Australians on, they will know the housing market for the last 15 years is like gone so insane that people with double jobs can't even afford houses anymore. So they have to start doing something somehow for the general economy in general. So they cut the inflation round. What does that mean is that the bond yields get stabilized for the time being. And with the position of Australia compared to Asia, which is going to be the driving economy for the foreseeable future, they're the only ones in a good position for it. This is why you get the correction afterwards. Because think about it. Let's say you're an investor. Let's say I gave you $1 billion right now, billion euros. Would you not take a sell when it's at a record high price? Would you not short it? Of course you would. If you can walk into a bank and say, I want to invest directly into the market. All right, minimal investment is 5 standard lots. Fine. Here's $500,000. I'll take a short in the Aussie dollar. The euro Aussie dollar to be precise. So I'm going to buy dollars, Aussie dollars. Yeah, okay. We can't benefit from it that much. We can trade the price difference. Like I said, I had a sell here, I think, and then obviously hit my stop loss. Then I let it run because I wasn't expecting him to do 0.5. I was expecting him to keep it low, but not that. All right, and I went back in. I think it was somewhere halfway here. I was actually surprised to see it go that high, but didn't really matter. I knew it would pull back to its normal level, so I didn't set a stop loss because I had different trades as well that were compensating for possible down draw. That is somewhere later. You should always trade with a stop loss unless you know what you're doing. If that makes any sense. And I started trading this on when it started pulling back, so I was okay to leave it and wait for the next week. And when it went down, I set the stop loss into the green and it was fine. I'll just let it run. I closed it, I think it was when it started retracing here. I was expecting it to retrace a bit more. So I could have made this extra, but whatever. Right, so if you would set up a pending order in nowadays for long term, so something like this, right? You would set up a pending order here for a buy anyway, and you would have nipped it. Right, there was an announcement here, which again was the NFP. It flatlined it because we knew it wasn't going to go into favor of the pound because, well, let's be honest, it's the pound. And at the moment, there was something else just happening, which was, Brexit was finally completed. I don't know how long it took them. And now a whole shitstorm of problems is coming forward. So the pound's not going to get anywhere high for a while, but we knew it wanted to complete its downward trend anyway, right? It wanted to finish that run. And you know where the run will finish is your resistance line. Right, so your take profit was there and your entry point was where their buy was there anyway. All right, so at the moment, fundamentals is not the way it was, let's say, pre-COVID. It's not even the way it was 5 years ago or 10 years ago. And this is why it's important to keep looking at the history, how it develops. Like I said, the NFP used to be the most important thing. Now it's, worth an hour trade and then nobody cares. Right, so this is, it's much more complicated than this, but unfortunately, you would have to really, really get into it. We don't have that time because I'd like to wait for something and then live set it up with you like this. It will pull back. I would take a buy, go back here, and then take a sell. How do you set that up? Well, you could do a pending order. You can, say a buy stop when it gets back to this because it will probably not go past this point right now. This is a day chart, by the way. Right, because you need to look at the big picture, and it hasn't broken that basically all of last year. This was, again, fun stuff in March. All right. So that brings us to